Unlike the United States, where the IRS computers only read the first 2 pages, i.e. the jacket of your corporate tax return, in Canada, the CRA computers can read and analyze every single number on your income tax return, including the jacket and including all the backup schedules. I'm going to talk about 5 key differences between the Internal Revenue Code and the Canadian Income Tax Act, that not knowing these differences can lead you to problems, and again, why you need a Canadian CPA in your corner. Number 1, we do not have consolidated returns up here. So if you have one subsidiary with losses and another subsidiary with income, the subsidiary with income pays tax and the subsidiary with losses has a loss carry forward. Our provincial tax nexus is much different than your state tax nexus. And if you have nexus in a province, you're probably going to have to collect the sales tax there and probably have to file there. You have an asset up here in Canada where the depreciation for a year is $1,000. I actually have the option on my tax return to claim anything between $0 and $1,000 for that asset in the year. This has great implications for the GILTI tax, because as you know with GILTI, if you're taking the 962 election, you're going to get the best result if your taxable income for Canadian tax purposes is the same number as the taxable income for GILTI tax purposes. So this is something we use to try to get those two numbers equal so you don't end up paying the GILTI tax in the US. Loans from a Canadian subsidiary to a US parent, if they're outstanding for more than a year, will be deemed as dividends and subject to withholding tax. If your sub lends your parent $1 million and it's outstanding over a year, you're going to get whacked with $50,000 of withholding tax. In the Internal Revenue Code, loans from subsidiaries to parents are fine as long as they're done at a fair market value interest rate with fair market value terms. Not so in Canada. All loans outstanding more than a year, and by the way, a year is only a guideline, okay? It doesn't have to be a year. Any loans from a Canadian subsidiary to a US parent will be recharacterized as a dividend and subject to 5% withholding tax. Once this assessment is made, you cannot get out of the withholding tax by paying back the loan.